If you look at the US stock market, it would seem as if we are in a relatively good place. Markets have been approximately at the same level for about a year and a half, but hey, who's counting? All that matters is that the Fed will be there to backstop any losses, and that Janet Yellen telling us that there would never be another crisis is legitimate and realistic. Thanks, Janet. And now, back to reality. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening in the markets. Some interesting things have been occurring and a lot of people are simply unaware of it. They don't really care about it. All they care is what they are holding on to and hoping, praying that this continues to rise. Status quo is what everybody is searching for, not to have actual, real, meaningful change to provide strength to the economy and the markets. No, they want status quo. And it is this behavior that always creates these boom and bust cycles that we see time and time again. Performance of US versus non-US equities, you're looking at the MSCI All Country World Index excluding the United States, and then the S&P 500. And of course, the S&P 500 is just one index. I would actually like to see the Wilshire in here instead, but let's take it for what it is. So this right here shows you a very, very clear indication that the markets around the world are not doing well. Yes, they have come up from their low point, but in general, the S&P 500 has performed a lot better than the rest of the world. And this has been the case for a long period of time here. As we have seen all together, the markets haven't really been able to do well in a state where you don't have excessive monetary easing. They have been printing money, we know that. It hasn't been at the rate they were doing before, and as a result, the markets haven't been able to rise. The only reason why markets are rising, of course, are number one, stock buybacks, and number two, central bank quantitative easing. This is an absolute fact. We know this, documented this hundreds of times on the channel, but I just wanted to show you this specifically, that when we look at the market, we have to be very clear as to where we're looking at the US, or are we looking at Germany, are we looking at Italy or Canada or Australia or anywhere else. We must be specific in that because it seems to be a very big difference in between what's happening in one country than another. So we're coming close to the half point of the year, and you can see the announced buybacks for S&P 500 index companies just showing you here. It looks like it might not be as significant as last year, but still historically incredibly high. But we'll see how this all really plays out as time goes on. Just trying to give you an idea. Last year, I believe it was 1.1 trillion. Now they're showing us a different number here for 2018, but ultimately it doesn't matter. The amount that has been printed since the financial crisis is consistently rising. That's what we know on average. And of course, we have seen how the stock buybacks have affected the market dramatically. There have been studies that have shown the markets would actually be 19% lower than where they are today without stock buybacks. Now, of course, stock buybacks are there. And so, of course, this has led to what we have seen. And it's not going to be removed. It doesn't look like that's going to be the case, although perhaps they're trying to put that into law. I don't think it's going to happen. We know that previously, a few decades ago, it was considered stock manipulation, price manipulation, in order to actually do stock buybacks, but that has changed, and ever since we have seen how they have been such a important part of the markets that I really don't see it changing anytime soon. The 50 stocks that matter most to hedge funds, and if you close your eyes, I bet you can guess exactly who is on the top of the list. So looking at the number of funds with stock as the top 10 holding, I mean, it's really not a surprise to anybody, but Amazon, Facebook, Microsoft, Alphabet, Alibaba, Netflix, and we go down here and we'll see the usual suspects. The FANG stocks are obviously part of this, and you're seeing that they are in fact chasing what the central banks are doing. The central banks have been purchasing up these FANG stocks, and it has been very positive for their portfolios. There is no doubt about it. Obviously, we have seen at this time this narrowing band that as time goes on, fewer and fewer stocks are being purchased by these big hedge funds, by the central banks, and so so on, and then ultimately that does create a problem at some point in the future. When the time comes in order to sell, this is usually the case where we have an extreme sell-off. But I'm going to see how this actually does occur this time around. We never really know, but that's historically the way it has happened. So it is worrisome. And we're looking at the 50 stocks that represent the largest short positions. And I just wanted to touch on one very important issue, and that is because of the trade issues that are happening today, semiconductors end up on this list many times, Qualcomm being on the top of that. However, look at the total return year to date, 47%. So this has obviously been a very different year for them, other than some of these other ones that have not done as well. But in general, I do believe that many of these investors out there, the computer algorithms of course, have priced in the eventual trade deal to occur. It's priced into perfection, absolute perfection. If they do not have a trade deal, or it looks like this isn't going to happen anytime soon, let's say next year, the year after, and there's some sort of tensions where the two countries say, we're never going to talk to you again, forget it, this is going to be detrimental to the markets. But they couldn't always be reassured by none other than Janet Yellen and her friends at the Federal Reserve. I wanted to switch gears here to show you something that is happening with these computer algorithms and what exactly they are doing today. I have talked about this many times before. I have broken it down in many videos, but this here gives us a little bit more insight into what these companies are doing. Now, in fact, a lot of them do not speak of what they do specifically because they don't want to give away their trade secrets. Take a look. BlackRock, the global investing behemoth that has big plans to increase its presence in China, tracks changes in retail investor sentiment by analyzing social media data, including about 100,000 chat room posts a day on these particular websites. The firm buys stocks that attract growing attention from investors and sells those that show waning interest. So they are literally looking at what the retail investors are doing and they are into in order to buy up certain stocks. Now, I don't think that this is necessarily making up all of their investments, but this one particular computer algorithm is doing so. Now, a couple years ago, there was this other company that started looking at all of this data in the most viewed stocks of these trading apps, and they were doing so well until everybody started jumping on the pile, and it actually created a problem at one point back in 2015. There are other examples in here. They're talking a lot of the details about what they get into, but essentially the article is talking about quants thinking like amateurs in the world's wildest stock market, and that is referring to the Chinese stock market. So this here is just giving you an idea of how these computer algorithms are actually approaching all of the data that comes out. They take it in automatically and trade on it. You as an individual, you can't do that. The algorithm of course, will be the detriment to the stock market next time around. I really do believe that there are going to be several moments where we experience halting on all of these stocks on the markets. The indexes have to shut down repeatedly because of how fast these are beginning to sell. And this is going to create panic for a lot of people. Wild swings, China's main stock index has the highest volatility among major global peers. And that just shows you China at the top 28%, below that Hong Kong, Germany, Japan, and so on. And one very important institution globally, Deutsche Bank, I've been covering it as it falls lower and lower and lower. My goodness. Deutsche Bank is planning cuts at its U.S. equities business, including prime brokerage and equities derivatives, to win over shareholders unhappy about its performance. Okay, you got some bad performance, not doing well, so you fire a whole bunch of people. At the very bottom, it's unclear of how many of the bank's 9,200 U.S. employees will be affected, and no final decisions have been made. But they did talk about getting rid of a lot of people. The CEO, I believe it was, came out and said, you don't have to worry, we are prepared to make big cuts. And of course, this here is something that will happen. We're going to see that. We've already seen many corporations getting rid of people, and this is happening at a time we're being told everything is a-okay. Well, not so much. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a like on this video, you're supporting me, supporting this channel and the truth. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z, foundation, history, asset classes, and all the details that you need. Check out the link in the description if you want the audiobook that's available at themoneygps.com. If you want to know what's actually happening in the economy, you need to watch this video. It has gone nearly 100,000 in a matter of a few days, so definitely check it out, and I'll see you there.